The following analysis is for educational and informational purposes only and does not constitute financial advice. Geopolitical conflict has triggered severe disruptions in global energy logistics, including blockages in the Strait of Hormuz and the suspension of natural gas production. These disruptions translate into immediate systemic risk for Indian mid-cap industrials. This creates a macroeconomic paradox. India's foreign exchange reserves appear stable on paper, yet the central bank is being forced to burn through that capital at an accelerated rate. The most observable symptom of this capital drain is the depreciation of the Indian rupee, currently testing the 93 mark against the US dollar. To understand the pressure on the central bank, we must map the transmission mechanism, tracing how global crude spot prices systematically destroy domestic corporate margins. The baseline structural vulnerability of the Indian economy is defined by volume. The nation imports 85% of its total crude oil requirements. During the 1991 balance of payments crisis, India held enough foreign exchange to cover only 19 to 20 days of imports. While today's reserves are mathematically stronger, the underlying pressure remains identical. The Reserve Bank of India is aggressively selling foreign exchange to prevent the rupee from crashing past 100 or 120 per USD. This defensive currency selling maintains short-term stability, but it creates a severe and finite drain on the nation's sovereign capital buffers. As the global shock inflates the national energy import bill, the current account deficit widens. The current account deficit measures the gap where the value of a country's imports exceeds the value of its exports. The central bank is currently absorbing the brunt of this macro shock. However, as this defense relies on finite reserves, the financial damage will eventually cascade down to the corporate level. The core driver of this crisis is a deficit in physical infrastructure. India lacks adequate strategic petroleum reserves, government-maintained emergency stockpiles of crude oil. Without these physical storage buffers, Indian oil marketing companies cannot stockpile cheap oil during market downturns to offset geopolitical volatility. This creates the spot price trap. Lacking strategic reserves to draw from, India is forced to secure offloaded shipments on the open market at extreme peak spot premiums. This flowchart maps the mechanics of the trap. The constant 85% import requirement bypasses empty storage infrastructure and routes directly into high-cost spot market purchasing, instantly draining forex reserves and inflating the national import bill. We are already seeing these costs hit the market. The Indian Oil Corporation has enforced to raise industrial fuel prices by 25%. This structural policy failure ensures that any global geopolitical shock acts as an immediate, unavoidable tax on Indian corporate profitability. Moving from macroeconomic theory to corporate reality, we must look at the specific sectors bearing the weight of these industrial fuel price hikes. Take the Morbi ceramics cluster in Gujarat as a primary case study. This single region is responsible for 75,000 crore rupees in annual exports. The sector's vulnerability is tied to its energy requirements. Ceramics manufacturing is overwhelmingly dependent on natural gas for high-temperature heating processes. This dashboard calculates the margin destruction. With contracts locked in, fixed revenues are overwhelmed by the spiking cost of natural gas, resulting in negative operating margins. This broken financial equation has led to the complete operational shutdown of the Morbi export cluster. Global energy shocks present an existential operational threat to import-dependent, gas-heavy industries. A second sector facing an equally fatal vulnerability profile is the Indian textile manufacturing industry. The supply chain suffers from a temporal mismatch. Textile manufacturers are locked into fulfilling old orders based on historically low, fixed pricing agreements. However, the cost of petroderivatives necessary for production, like plastic polymers and polyester, has doubled or tripled due to the energy shock. Fulfilling fixed-price contracts using these inflated raw materials completely crushes corporate margins. Broadening the scope back to the macro level, we must consider a secondary contagion risk, the threat to Gulf remittances. Regional economic slowdowns and job losses across the Middle East threaten this alternative source of foreign exchange inflow for India. The combination of collapsing domestic export margins and threatened foreign remittances creates a perfect storm for currency devaluation. Long-term reliance on imported LNG and LPG is mathematically unsustainable, acting as a structural drag on Indian equities. Systemic energy insecurity is forcing a capital rotation into domestic, decentralized waste-to-energy infrastructure. The specific alpha vector for institutional investors is compressed biogas, or CBG, a renewable fuel produced by the anaerobic decomposition of agricultural and municipal waste. Nifty estimates that India has a generation capacity of 62 million metric tons per annum, derived from agricultural and wet waste. This chart compares India's current total LPG demand at 30.8 million metric tons against the estimated domestic biogas generation capacity of 62 million metric tons. Harnessing even half of this domestic capacity would mathematically eliminate the need for LPG imports entirely. Waste-to-energy represents the mathematical solution for India's energy and currency security. The government initially attempted to catalyze this sector with the 2018 SADAT scheme, which aimed to build 5,000 CBG plants by 2024. Policy rollout failed to meet its targets, as financing bottlenecks and complex approval processes resulted in only 1,332 plants being constructed. However, massive private institutional capital is now aggressively entering the space. Reliance Industries has committed a 65,000 crore rupee investment to construct 500 new compressed biogas plants. This map visualizes the shift towards heavily concentrated mega investments, including this 500-node cluster specifically over Andhra Pradesh. The roadmap focuses on decentralizing production, generating fuel for the transport sector, and eventually blending biogas into piped natural gas networks. With mega-cap corporate balance sheets replacing lagging government schemes, a structural multi-year market rotation has officially begun. The ongoing downside risk to any import-dependent, gas-heavy manufacturing sector remains highly elevated. Analysts must actively model the risk of margin compression in companies that remain reliant on volatile spot market industrial fuels. To generate long-term alpha in the Indian market, investors must look past vulnerable traditional industrials and track the capital flowing into emerging decentralized compressed biogas networks.